Well, welcome. On behalf of the Jellis Group, welcome to all of our very important clients to this evening's information event. By way of introduction, if I haven't had a chance to meet you so far, my name's Andrew McCann. I'm one of the principals for the Jellis Group and across our offices, which cover the suburbs of Armidale, South Yarra and Richmond. Tonight, I'm here to introduce more than anything our team, but certainly to welcome you all, our clients, and to say, firstly, thank you for your loyalty and for your custom and the fact that you employ us on a daily basis. We hope that we're serving you well. We see these evenings, and hopefully we'll see more of them introduced into our program, as a great opportunity to try and provide some insight and to give back and to value add to our relationship more than anything. So we've got a few topics to cover this evening. Given my role in our business is global, I sit across our sales business as well as our property management business. We've just come through a federal election. The tone has changed dramatically in terms of the way that we're hearing about the property market. I thought I'd just give you a few insights into what we're seeing on the sales and the value side of things. I'll then introduce to Peter Siebert, who's going to talk on one of our topics today, being more involved in that investor lending in the finance space, and she'll pass through to the rest of the speakers for this evening. One of the things that we get asked regularly, certainly at Open for Inspections, is what's happening with property prices. What are we seeing? Have we hit the bottom? Are things changing? And I just added this graph into tonight's presentation. It's supplied by CoreLogic, who effectively provide us with a lot of data, collect most of the sales data across the country. They're the number one provider of sales data to most of the banks and the economists. The really hard fact is that we've seen about a 10% reduction in property value across Victoria. That's the statistic. It's pretty well supported, and it seems to be the case for most of the markets that our business operates in. Our peak in the market around 2017 has had gradual decline. We feel broadly that the market started to show some signs of stabilising, recovering over that past period, but this graph I think is a pretty good representation of the reality. From the peak of 2017, it's been, rather than an off-the-cliff change, it's been a gradual change. The marketplace for this year has started to show some signs of that stability, and I'll talk about that in just a moment's time. The bigger factor from a business perspective, and one of the things that's continued to support the property market, I'm not sure if you've seen some of the commentary on television shows like 60 Minutes, where you'll hear random property economists tell us that the market's about to change and property values are overvalued by 40 or 50%, that we've got another 2 or 3 years of potential pain or potential losses. Certainly in the markets that we operate, we don't feel that. We certainly don't feel threatened by that. But the fundamental that continues to drive the quality property that we sell and manage on your behalf through the best suburbs of Melbourne is very much driven by supply and demand. The volume of sales has been very well affected over the past 2 years. If you looked at this graph, and you can actually see the dates, in 2017, we're about 25 to 30% off the sales that we're making in 2017 in pure volume. So if you looked at the best auction weekends in any marketplace across Melbourne, and you read the papers or you read the reporting, those bumper weekends used to be 1,200, 1,300 auctions reported. These days we're thinking a big weekend looks like 600 or 700 auctions reported. So what's continuing to hold our price positions and continuing to provide the number of transactions that we are seeing, and it is a transactional market. A lot of property is selling, and it's selling well, and it's very stable, and I'll talk about some of those key points in a moment. But the change that we've had in the business, we've seen 25% less transactions over the past 12 months. That's compounded by 15% the prior year. So we're effectively 40% down since 2016. Now, what does that mean for you all? It means that the market is very much in a state of, I wouldn't call it a state of flux, but it's in a state of hold. Because interest rates are low, people can afford to continue to hold their properties. There's no forced selling across the best suburbs of Melbourne that we're seeing. We're certainly not hearing of a lot of mortgage stress and pressure, certainly with continued interest rate reductions. And people are not seeing the properties that they're looking to buy and upgrade because they're simply not on the market. So the best properties are continuing to sell well, and we're not expecting for that volume to change. Some of the things that we're expecting in terms of, I suppose, where the current market is at, pre and post-election throughout this year, we've seen the market start to show that sign of meeting the bottom. And I think if you were to drive around in one of the cars of whether it was myself or one of the sales team in the early part of this year, most of the auctions that we ran through February and March were challenging. Often one bidder per auction campaign, a lot of pass in, negotiate. An owner might have been hoping for a result of 2.5 million. More often than not, the buyer was coming forward at about 2.3 to 2.4. So that price agitation in the market was causing, I think, a clearance rate of around 50% most weekends. Most of those properties ended up selling, and I think owners have been through that period of adjustment of recognising what the new normal is for price. But over the past 6 to 8 weeks, we've certainly felt that change. I wouldn't say that we're feeling a change and that we're launching back into the highs of 2016-17, but there have been actively more bidders at auctions over the past month, and clearance rates are starting to improve. Values have certainly stabled. Auction clearance rates is a key measurement in any market. How those auction results come about are probably more interesting to us. Do they sell at the negotiation table? Do they sell before auction, or do they sell with 2 or 3 bidders? Bidder number is the real key to demand, and that's the real indicator that affects value. Once you get demand back into the marketplace, we'll start to see those prices climb again. Numbers of open for inspections, or people through open for inspections, has increased. There was a statistic presented to us yesterday by Domain. The Fairfax publications have shown that there's about 10% more people going through property at open for inspections since the election. So it's interesting to see that since the stability that's been, I think, engendered in the commentary post the election result, we're now starting to see more people looking at property. The sentiment change in the reporting post I don't think there'd be anyone in the room who wasn't a little bit surprised by the election result. Certainly the polls and the reporting expected that we would have had a change of government. With that change of government, our property managers were thinking about what that might mean for our landlords and if there was to be changes in that negative gearing space. But there's certainly not an expectation that we mightn't have been going through some of the potential tax changes that were on the agenda. Since that hasn't been the case, it's been very interesting to read that most of the property pundits that were expressing concerns about continued price decline have now changed their story and sentiment. In the week post-election, we had property prices being reported as stable and only looking to increase from this point. We had conversations coming straight back into the market about interest rate reductions, and we've also had further conversations about APRA starting to ease on the lending and the strict lending criteria, and I'm sure you'll hear a bit more about that later. So all of those things put into the pot suggest that we're really coming across the bumps of the bottom in the property market. Having peeled back arguably 10% of value in most suburbs, it's probably as high as 15% in some areas where markets were extremely heated and arguably inflated. But there is a real stability in that marketplace, and I think we all feel very comfortable about that. Our expectations are that unless the volumes are really to come to the market and we see listing numbers increase, that property prices will continue to be quite stable, and it should be quite a stable market. Those auction clearance rates have come off an average of about 50% to being as high as 65% across the state over the past month. 2 weeks after the federal election, the Jellis auction clearance rate off 60 auctions was 85%, which is the first time that we've touched over 80 in a year and a half. So I think knowing that we operate in that mid-band of the inner Melbourne part where property is arguably a more heavily contested product, it should give real confidence that we're in that recovery mode. Low volumes of listings, I think, unless any of you are of the view that you would like to sell, we're certainly here for you in that regard, but we'd love to continue to manage your properties. We're not expecting there to be a flood of property onto the market. One thing that has driven a market in the past has been unemployment, changes in economic conditions, or interest rate rises. Obviously, interest rate reductions allow people to hold, so that creates more of a hold, which means that we don't see those properties coming to market. Those people that are looking to upsize aren't necessarily seeing the available stock. So until that changes, I can't see that the market's going to change around the volume. So it'll be slim pickings throughout the remainder of this year, but I think a fairly stable environment. Quality property, if you were driving up and down the best streets of whether it was Richmond or South Yarra, Armidale, Malvern East, is in short demand. So it's in high demand, and in short supply. We've seen in the last month and a half where you might see 10 family homes on the market in the suburbs of Armidale, Malvern and Malvern East. There's been 3 properties. One property in the 3 million to 4 million bracket in Armidale sold with 6 bidders, I think, around the mid-threes against a 3.4 million reserve. That's a really good indicator that buyers are starting to accept today's market value are also accepting that the conditions won't get any better to buy, and if you are of the view to buy, that now's probably the time to move forward. So they're our forecasts, our expectations, what we're seeing at the moment in that environment. Certainly open to debate and conversation, and happy to answer questions. From my point of view, I'll certainly be here at the end, and if anyone wants to come up and have a bit of a chat about the market broadly, I'd welcome you too. But in the meantime, I'll introduce Peter Siebert, who's going to be a bit more topical, and he's going to talk to you more from a banking perspective. So thank you for your time, and again, on behalf of our business, thanks for coming on this evening.
Hi everyone, Peter Siebert. I'm the Managing Director for Avenue Financial. We're the mortgage broking arm connected with Jellis Craig. So today's really about me giving you an update on what happened before the election and what's happened after the election, how it's impacted you, and what are the good things really moving forward for investors. So tighter interest-only lending is what happened beforehand. Interest-only basically, in a way, disappeared or became quite hard. The reason behind it is the banks still want customers to repay their debt. But what was happening is so many people were holding debt on until they retire, then trying to sell the property. If property prices did drop and people weren't paying any debt off, it was creating more of a risk, and again, a risk for property prices dropping down because there'd be a lot of property on the market. So the LVR, which is the loan, so let's say 80% against the value of a property being 100, the LVR was 80%. Interest only reduced to 80%, so if you had a 90% loan or anything higher, the banks would turn around and say, sorry, you either have to refinance or pay P&I repayments. At that point in time also, interest rates were going up and up and up. That's all before the election. It also changed again that the interest only term being a 30-year loan, you want 5 years interest only. The banks then said, well, okay, you have to service it over 25 years. So there's all this negativity around how do we control interest only investment lending, how do we give the first home buyers more access to the market, the investors, naughty investors, we can't give them any more. Not really quite true. So things looked really bad, but really weren't as bad as what everyone thought they were. Negative gearing as well, before the market changed, was pretty much gone. It is there, but it's not a heavily used income for servicing debt. Self-employed people for low doc went out the window. We could do 80 and 90%, we can still do 70%, and it dropped down to a 70%. And of course, at that point in time, valuations were coming in a little bit shorter. So I was getting lots of questions before the election around why can't we get lending? You could always still get lending, but what we had to do was show evidence. And unfortunately, the way we used to do it to the way we were doing it, people weren't willing to give evidence of transactions. This is what I was doing day in, day out. And that's unfortunately the way the market has moved. So then the Royal Commission announcement came out and they put all these other things in place, and look, most of those things are good, and that's in relation to protecting the consumer, whether they're an investor or not. Again, the election happened, and then finally everyone knew, the banks, the consumers knew exactly which direction they were going, whether the property prices were going to go up or down based on the things that were happening with the government, or whether the banks were actually going to be preferred, or whether we had access to brokers in the market who actually can have competition. Good thing was, from my point of view, the right group came in. Since then, exactly what Andrew is saying, the market has actually got excited and is starting to move forward, and that's consumers as well as the banks themselves. So interest rates have actually started to reduce on investment. The bank's 10% threshold, which a lot of people don't actually understand, a bank has a restriction on how much they can borrow year to year, and APRA and ASIC audit that. Now, the difference between APRA and ASIC, APRA audits banks that have deposits, so term deposits or transaction accounts. ASIC audit the banks that don't. So Big Four with APRA, I'll give an example, Aussie Home Loans, everyone sort of knows them, they get audited by ASIC. Liberty gets audited by ASIC. So they're two lenders that you might understand the difference, but pretty much it's exactly the same. So if you have interest-only debt and it's $100 million last year, you could only do $110 million in lending. And what happened with Westpac is a really good example, is they reached their $115 million, I'm going to use that, 15% threshold, over 5% over. The banks turned around and went, you know what, guys, you can't do any more lending. So they would do their refinances on 1 week, and the next week, based on the refinances, they do their new purchases. It was that strict. So that's all loosened up a little bit, and some of the things that you would have started to see is obviously LVRs, interest rates changing, and tiering starting to happen. That also allowed the off the plan to come back into the picture. So anyone who does want to buy an investment property off the plan, we can go up to 90% LVRs now. Whereas before the election, that all got cut back. They was all concerned about oversupply in the market, and that's all come back in order. LVR pricing, again, which is that 80,000. So your borrowing capacity or your borrowing amount gets impacted again by the lenders. And what they're now doing is they're tiering it. So don't assume that you can't get a loan, because you can, is what I'm trying to say. What it is though is everything's all tiered. And just because the big fours are saying no, doesn't mean that the others are saying no. We are seeing that obviously property prices are flattening out, which is a good thing, which means that's why our off the plan LVR is going back up to 90% rather than 70%, which is what it was previously, because we're not expecting property prices to continue to drop, we're expecting them to flatten out. So the impacts for you is you can still get lending, there's no issues around that at all. Interest only terms, can't do it over 30-year repayment. If you do 5 years interest only, not a problem, but it's serviced over 25 years. It's not that you can't do it, you just have to have a think about it a different way. Exit strategies. I have to have an exit strategy. I'm just shy of 50. If I do a 30-year loan term, how am I going to repay it when I stop working? Now, it's okay for an investment, and I own my house, so I can pay it. The bank's not going to kick me out onto the street. And that's the same for most investors. But if you're relying solely on rental income, and then let's say those rental properties, for whatever reason, you can't get a tenant in there, and you don't have, I'm going to hand your landlord insurance in place, it can cause some risk, and that's where the banks don't like that heavily geared. So we just need to diversify now across many lenders rather than having that loyalty with one bank. So again, it's not that you can't do it, it's about being a little bit smarter with how you manage your finances. So as I said before, your rate versus risk, interest only versus P&I, easiest way of saying, this is the way I've always said to all of my clients, whatever you buy a property out, pay it down to 80% of what the value of it is, and then from then onwards, interest only. Gives you that buffer, gives you that security. If everyone had been doing it over the last 29 years, we wouldn't have any issues with interest rates. Living expenses. Living expenses, guys, is not about going through 3 months worth of statements. It's about having a conversation with you, your broker, your banker, whoever it is, about what you're spending and why you're spending it, and actually mitigating it if it's not things that you need day in, day out. Example is, I have a wine room, my husband goes and buys special, that's a couple of $1,000s, and then I went and got a loan. Guess what? That's not a regular expense. But if someone just looked at it and just said, this is what your monthly expenses are, it would be too expensive. So you just need to have that conversation with whoever that person, that lender is that you're working with. Development funding exists. For those of you who do want to do development funding, it's just the big four don't do it anymore. Lender diversification is something you need to be comfortable with moving forward. Think of it this way, it's not your money that they're taking, it's their money that you're taking. Okay? So what's coming soon? Predictions from a banking point of view. Flat valuation or property prices, end of 2020, 5% increase from what we're expecting the value to be now. That's what the bank's saying that it is. Changes to assessment rates means that there's greater borrowing capacity. So right now, you go do a loan, your rate might be 4%, the bank's assessing it as 7.25 to 8.5%. That's in the process of being reduced, and that's some of the things that you'll start to hear in the network. Right now, we've got one lender who's already got ASIC, or it's in the process of, having APRA approval. It's actually going to increase people's borrowing capacity by an extra 100,000. Not a lot, but it's a decent amount to get some. So if some of you have tried to bid at auctions and weren't successful or had finance declined, have a chat with us. RBA movements, 2 more. July, August, and one in November. Please bear in mind, it doesn't mean that the banks are going to pass it on to you. Example is 16 basis points to 25 basis points was passed on. Term deposits were dropped 20 to 30. You can't have your cake and eat it too on both sides. So what will end up happening is the banks will either pass it on initially, then go buy money. Money goes up, interest rates go up. Back book and new business. So existing customers and new business, which is not what we want. So in one respect, I'm quite happy if they don't pass any rates on. At least we've got these rates that we have at the moment moving forward. I've been told to wind up, so sorry guys. I'll pass it on to Tim from EBM. Thank you.
Thank you for your time, everyone. My name's Tim White and I'm from EBM Rent Cover. We're proud to be aligned with Avenue Financial and Jellis Craig to help protect their landlords from some of the unique risks and exposures that you guys face owning a rental property. Today I'm just going to touch on a couple of the evolving market trends in insurance and more specifically drug houses and also pets. Before I do that, I just thought I'd give you guys a little bit of a background about our business. We wrote the first ever landlord insurance product back in 1991. So for over 25 years now, we've been market leaders in this space. We currently insure over 150,000 landlords Australia-wide, having an office in every state and having 100 staff employed as well. In the last 12 months, we have received approximately 5,500 claims, paying out over $20 million. So the first evolving risk I wanted to touch on was pets and pet damage. Look, this is something that Sam will probably touch on after my talk. There are some legislation changes in terms of pets, and for some of us, we might be aware that you won't be able to discriminate against pets any longer. Don't be alarmed by this. We got some research to tell us that pets aren't necessarily a bad risk. For starters, 63% of all Australian families own a pet. So essentially, if you're looking at rental lists in Victoria, especially over the last sort of few years, you will notice that no pet clauses and no pets in advertising is quite a common theme. So the crazy thing from my point of view is those landlords are shutting out more than half of their prospective tenant pool. So obviously with the new legislation coming in, the good news is that will open up to obviously 100% of the prospective pool. We've done some research to see some trends with those that own with people that own pets, and our stats will actually tell us that people and tenants that own a pet are more inclined to look after your property than those that don't. In terms of the return you can get from someone that owns a pet, some statistics that we received after doing some research was that tenants are willing to pay 7 to 14% above their budget to ensure they can secure a property with their pet. So obviously, again, it's another staggering statistic to tell us that these prospective tenants and tenants need to be given an opportunity. Sam did want me to touch on a couple of claims examples that we've had in this space. And look, for us, we've been prepared for the legislation that's coming for about 3 years now. About 2 years ago, our biggest claim that we saw at the time was a dog, a German Shepherd, that got underneath a standalone property and chewed some ducted heating vents, $14,000. So that was as bad as we saw until earlier this year. Earlier this year, we had a gentleman that was renting a property in South Bank. He had 3 cats and he'd been at this premises for 2.5 years. The routine inspection reports from his agent showed that this tenant was getting a little bit slack and negligent in terms of looking after his pets. And basically what ended up happening over the 3-year period or 2.5-year period was that we saw that these cats actually never saw daylight. So they were inside the property the whole time. So you can imagine they were doing all their business inside the property. Any spots there was urine obviously got through the carpet and onto the concrete slab. And then of course we saw the floating floorboards all bowed and bent and everything like that as well. But something else that I hadn't seen in my 12 years in insurance was all these little yellow spots on the ceiling in every room. And when I was asked my opinion, I was sure it was water damage from above. But after getting some forensic cleaners out to check out the property, it turned out to be fly excrement. So there were so many flies breeding in the property that they too were doing their business on the ceiling. So That is as bad as we've seen at this stage for pet damage. Again, that's one, it's a dime a dozen, so to speak, and it happens to be in Victoria. But, in general, pet damage claims are usually around that sort of few grand mark. I mean, I know it does sound like a bit of a hit, but it's not as severe as the one I'm going to talk to you guys about next. And that's drug labs, and more so drug houses, and more specifically methamphetamine. For us as a business, we're averaging about 2 claims per month with drug labs. And more than half of those are methamphetamine related. To give you guys a little bit of a picture of what a methamphetamine claim does look like, I have one case in WA, in particular, that after the tenant vacated, new tenant moved in, new tenant had stated that they could smell something funny. Some testing was done. So for us, our policy will respond to an owner that suspects high-level usage or someone that's manufacturing these drugs. So look, in this particular case, we had to approve some swab testing to be done. So what's that mean? It means that we get someone to go out there, and it's not any of these companies that do these quick sample kits. We actually have to get proper samples done, get it sent for testing. We usually don't get results for a couple of weeks. So in this period, the 7 swabs that we received probably cost the landlord about $2,500, but they did come in positive, which means that we covered it. If it came out negative, unfortunately, it would be a cost that the landlord would have to wear, and hence why I say there needs to be, pretty good evidence that there's something going on in the property. It can't just be an assumption. We do have some landlords that are trigger happy and want to get the property tested for every property. I think that's going a bit overboard. But as mentioned, the couple that we're getting a month, there is obviously exposure that you guys will face from these sorts of tenants. With this drug lab, particularly in WA, the swabs came back that there was a reading of over 1.5 micrograms of the chemical in the air, which means that those levels need to be under another 1%, so to speak, for the property to be habitable again. Some forensic cleaners came in, cleaned the property out. Some retesting was done. So again, think about this. This is probably about a 6-week stretch. So in this period, there's no loss of rent. There's no rental income coming in for you guys. Again, the readings came back and it showed that there was more than 0.5 micrograms, which meant that treatment was required on the areas that were affected, which basically meant that we had to arrange for the property to be repainted, carpets to be redone, flooring to be relaid, new fixtures and fittings, new bench tops. So in the end, this claim did drag out for almost 12 months. The good news is with our policies that it did respond in the landlord's favour, and we did cover loss of rent until the property was fit for lease, as well as covering all the replacement of the fixtures and fittings. In terms of the trend that we've seen with methamphetamine, unfortunately in Victoria, is that we did see it initially in regional areas, made its way through the west, but unfortunately it has now hit the CBD, and we are seeing them in high-rise apartments. The Jellis Craig team here will be familiar with the story I told them about last year with a property that was infected in Claremont Street, and it was a high-rise apartment. So the unfortunate thing is for these types of claims, we can't, we don't have a crystal ball. We don't know who's going to be applying for these properties. Quite often it could be someone who's on quite a good wicket who loses their job, and then the pressure of having to sustain that lifestyle means that they have to go to some drastic measures. The other thing too is that Vic Police had told us in this one particular case that the prospective tenant had 7 different phones. So one as an ex-landlord, one as an employer, one as an ex-employer. So whenever the property manager was calling to do the application checks, someone with a different voice was just answering their phone and telling them what they wanted to hear. So at the end of the day, unfortunately, some of the people that do these practices are professionals, and they'll know how to get around the system. But as mentioned, good news is if with the right amount of cover, you guys will be covered from such instances. So touching on a couple of things that I just mentioned. So pets, with pet damage, look, obviously there's no need to be alarmed with the new legislation that's coming in that Sam will touch on. Insurance has caught up to that space. You'll find that most specialist policies in the market now will cover pet damage to some degree. So my advice to you guys is if you do have a current policy that's not with us, just check the policy sublimits and make sure that the pet damage is covered for an appropriate amount. In regards to drug houses, meth labs and those sorts of things, again, this is something that most specialist insurers have caught up with. But for those of you who may be insured through a bank or a general insurer, look out for those policies, because those policies will have a general exclusion, which is that they will not cover any criminal activity in the property. So be aware of that when you're looking and researching your products and policies. And the third one I just wanted to touch on, guys, was probably more of a misconception rather than a risk, and that is that body corporate. So we still hear of a lot of landlords that believe that by having a property manager and by paying body corporate fees, that their strata fees and their body corporate fees that they pay in that will actually cover their property for landlord-related items. Unfortunately, those policies aren't designed to do that. They're specifically designed to cover the building only and the common areas. Some of these policies may have a liability component to the policy, but very rarely will it protect you guys in the actual property itself. So again, I urge you guys to review your insurances if you have a strata policy, and definitely consider looking at getting a specialist landlord product. So the other things to consider when you guys are looking at your landlord policies and specialist policies are the items that you'll see just over to my left. So we've talked about pet damage. You've also got your sort of standard insurance perils, so stuff like flood, storm, fire. But the other things to keep an eye on are your hardship and loss of rent. Again, a lot of policies on the market will cap loss of rent to a certain degree. Make sure that you have a policy that coincides with the Tenancies Act. And the other one I wanted to touch on was some legal expenses. So look, obviously if your property managers are fighting for you at VCAT, that's obviously going to cost you a fee for the application, but also their time in court. A good insurance policy should cover you for those costs as well. So thanks for your time, everyone.
Good, yeah. Great, cool. So for those that haven't met me, my name's Sam Noakes. I'm the head of the property management department for Jellis, Craig, Stonington, Richmond and South Yarra offices. You probably see my name on emails. That's me. My job is to manage the broader property management team within our organisation, and that means looking at how we go about managing property for you from a conceptual and strategic point of view, and making sure that we've got the right people in place. And the most important thing with our people is to make sure that they're trained and that they're trained well. That's a really big project for me for the next 12 months, because on the 1st of July 2020, there's a brand new set of legislation that starts. So essentially the Residential Tenancies Act that was last rewritten in 1998 has had a full rewrite, and there's a whole lot coming in it. So what I wanted to do tonight is, I'm not going to sit here and read the 427 pages of the Act out for you verbatim. I'm sure you can have a read through at some point if you want. I'm just going to cover off on some of the key pieces, and if you've got any questions, I'll be more than happy to answer them for you. I guess as far as the government's concerned, the purpose of the Act was to modernise it. One of the things that they've done in there that they feel is a really good idea is to rename everybody. So I don't know if you're aware, but you're not landlords anymore. You're residential rental providers. That is your new legal term. You're residential rental providers. But that's what you are now. And they're no longer tenants, they're renters. So the purpose of the Act was to modernise the language, and that's done with the view that this piece of legislation will have another 20 or 30 year term, and will cover a time where the number of people who are renting is more and is longer. The rise of rent vesting is ever present. I've got some clients in the room that I know who are part of that practice, who rent the home that they live in and lease out an investment property, and that's rising. And so just the change in consumer behaviour and landlord behaviour is something that's shifting far more to be like the European style of property ownership, and so the laws needed to catch up with that. It also has filled in some really great gaps. My favourite part is that Daniel Andrews, when he was spruiking the laws, is like, these are for tenants, they're great. But what I'll talk to you about tonight is that he's actually given you some really nice pieces in here for you to use. So modern regulation I spoke about before, mainly that's just in relation to terminology changes. It also includes some updated penalties, so there are larger penalties and more penalties for people doing the wrong thing. That does include landlords, and it includes financial penalties. The other one is, you would know, one of the things we check for you is the National Tenancy Database for when a tenant can be blacklisted. There is now a non-compliance register, is what they've called it, for landlords. So if landlords are behaving in a way that is against the Act and they have breach notices or orders against them, you will also now be logged onto a register that a tenant can search before they rent a home, and agents as well. So that's going to be a bit of fun. So before the residential tenancy agreement begins, there's brand new legislation around discrimination and just being very clear about what is discrimination and how we need to go about selecting tenants. Also around how we go about representing properties. So one of the changes that they hate, has anybody done developments before? And you advertise a number of properties together, right? So one of the things that they've looked to outlaw is that you must market the property. So previously you might have seen agents who will market an apartment and say, that it's the same as the other ones, but it's not actually those photographs. So those sorts of things have been shifted into misleading and deceptive conduct. So if you've marketed properties before under one ad, there'll be some additional costs in getting them some marketing materials created for them, rephotographed, and it'll just shift that behaviour. Because as you can imagine, unfortunately, it's not the people in this room that do it. It's your large developers, CBD. They advertise the best apartment on the 30th floor on Spencer Street, and then they go and rent out the one bedrooms downstairs, and they're not what you would think they are. There's also now a new duty to disclose. So a landlord needs to disclose at the commencement of a tenancy whether they intend to sell the property during the tenancy. So if you had an intention, you need to disclose that at the start. So again, for developers to know, and for anybody who's thinking of exiting the property, Peter's talking about exit strategy, just be aware of that as they go along. There's also, you have to disclose the embedded electricity networks and internet networks if you're in modern buildings like yours, Bree. If you're in a building where you've got embedded networks where you have to use a certain provider, that now needs to be disclosed. As well as a few other things. They're waiting for regulations to come out at the moment, so we don't know the full gamut, but it probably will include things like disclosing it, whether there's asbestos in the property and things like that as well. So we're just waiting for a bit more information on that. We can now put in a professional cleaning term into the lease, which I'm very happy about. But there are some conditions around that. It has to have been professionally cleaned before and it needs to be needed and so on. Not an issue for us, but when it comes to rent and bonds, you now must advertise at a fixed price. Jellis Craig's always had the policy of advertising your properties for you at a fixed price rather than a range. That's now removed, now not allowed to advertise a range. The one that Daniel Andrews did bang his drum about a lot is about rental bidding. And again, that's a practice that Jellis Craig doesn't get involved in. We're certainly happy to get the best offer, but not one where we go about trying to get every single person up. That's not the way we go about it. Highest and best is how we try to do things. That's now outlawed. So if we're going to be really careful, and we'll certainly talk to, Shannon from our team who does the majority of our leasing, we're really across this because it's about the language that we use. If we do have two offers, we genuinely want to try and help get the best person into the home as well as the best offer for you. And sometimes that's not the same application with those two elements. So it'll just be making sure we get the right approach for those. Rent increases as of this month, you can only do once per year. So if you've got a periodic tenancy, previously we would have recommended once every 6 months to increase the rent. That's now only once a year. Most owners only choose to increase their rents once a year anyway, so it's not a huge deal. Bonds. Now, Jellis Craig's always had a policy of bonds being 1.5 months rent if we're over $500 a week. Because the quality of the property is higher. Unfortunately, that's been limited back to being 1 month's rent. The only time you're allowed to take more is if it's double the median rent, which is now a shifting piece. It's out of interest. The limit at which you're allowed to take more bond at the moment is $350, which was double the median rent in 1998. And unfortunately, they didn't index it. They just left it at a single figure. So what they've done now is that it's double the median rent, and that's now indexed. It'll shift every year, so it keeps up with properties. Bond returns is a really interesting one in that if we don't make a claim on the bond by the 10th business day, the bond can automatically refund to the tenant. So say, for instance, if we've been talking with you about, hey, I think we should take this, or we need to make an application on this, or we should be getting quotes on this, and you're not quite sure, if we hit 11 days and the tenants put in a submission for their bond which they just do online, it just instantly refunds to the tenant if there's no counter application lodged. And that's to keep, because it's the highest number of hearings at VCAT. And it's also one where a lot of agents and landlords don't actually show up to those hearings. So it's just to get the number of hearings at VCAT drastically down. Tenants are allowed to make modifications to your properties and you can't reasonably withhold the consent. The tenants do have to rectify it at the end of the tenancy. So, Daniel Andrews neglected to mention that when he was out there championing this. But it's essentially the same as it is at the moment. The tenants come to you and say, I want to repaint that wall. The answer is sure, no worries. Repaint it back to the same colour that it was before. Not a big deal. And there's now, my favourite part about it, again, Daniel Andrews glossed over, is that it now requires tenants, they have to use a suitably qualified person to do it. So no tenants going out there with a roller and just doing the one patch. It needs to be done and done properly, which I'm very happy about. Thank you, Daniel. Now, this is the big one. So has anybody ever rented out a property before that they were planning on developing and it was an older home? Anybody done that before? Yeah, one or two. So that's going to be really difficult now because there's now minimum standards of good repair. And so what that means is that irrespective of what rent you charge for the property needs to be in good repair. So gone are the days of going, oh, look, we're going to develop it in 2 years. We'll just charge a low rent, but the water doesn't work and there's no toilet and there's a leak in the back room. That's not suitable anymore. They'll actually be completely ruled out. You have to maintain the property up to that standard, irrespective of what your plan is or what rent you're charging. Daniel Andrews has spruiked these laws as getting rents down. I somehow failed to see how that one's going to keep the rent down. Anyway, maybe it's just me. So minimum standards, we actually don't know what minimum standards are, but because the regs aren't out yet and they're inside the regs. We do know they'll include heating. So if you've got any old 1960s, 50s flats that don't have heating in them, you'll now need to include that, whereas previously you didn't technically have to, as well as a couple of other bits and pieces, but we'll communicate those to you at the time. There's some changes to the types of locks and a few other bits and pieces, but we're getting pretty micro at that point. So urgent, non-urgent repairs. Air conditioning previously wasn't an urgent repair, it is now. They've put that in. So previously that would be a non-urgent repair, we'd have 14 days. Now we're just going to get it done straight away. So best to have that checked up. Also, anything to do with a safety device is now an urgent repair. So pool fences, smoke alarms have to be done ASAP, realistically the same day if they're faulty. Just on pool fences, there's a new piece of legislation that's just gone through, which is that all pool fences will need to be registered with the council and that they'll need mandatory inspections. We don't know how often and we don't know what's being inspected. None of the detail of that act is written, and unfortunately every council is going to be able to write their own regs about it, which I find really strange, and they have their own register, and how you get on the register is different. So we're working closely with Stonington as a stakeholder on that, so we'll tell you what's happening with Stonington. We're trying to engage with Yarra, but they haven't even sort of put their mind to what they're going to do yet. So we'll keep you up to date on our main two municipalities as we tick along. You can now force the owners' corporation to do repairs if the tenant requests it. That's always been an issue. If anybody's ever had a property, say the apartment above leaks into yours, there's now some powers which allow us to get that done and ties into the owners' corporation part. When it comes to accessing the property, you now have better access to the property. Previously, when the property was for sale, you only technically had lawful access to show through a buyer. They've now reworded both that and the showing through prospective tenant sections to have an open for inspection to show through prospective buyers or prospective tenants, which is much better if you've got a selling campaign or you need to relet the property. What they've also done is you previously, when you're reletting the property, could only show the property technically in the last 14 days of the tenancy. So if you had a litigious tenant, didn't want to let you in, now it's 21 days. So Daniel Andrews has been very kind in giving you an extra week to try and get the property relet, which will be really handy, and I think we'll see a real drop in, probably an extension in days on market because the availability dates will kick out. No specified reason notice is gone. A lot of people got upset about that. A lot of landlord groups got upset about that. So for those of you that don't know, you've got a notice you can use called 120-day no specific reason at the moment. You serve it. You don't have to tell the tenants anything. In fact, you don't tell the tenants anything. And they have to leave in 4 months. That notice is gone. What you also have at the moment is a end of fixed term tenancy notice, which you must serve at least 90 days prior to the end, and it has to expire on the last day of the lease. Daniel Andrews has been very kind and said no longer. Now you can serve it whenever you want, and it just has to expire on the last day or after. So whilst he's taken away the no reason notice, he's actually giving this great end of fixed term tenancy now. And that notice is almost unarguable, and it's almost can never be a retaliatory notice anyway. So it's much, much easier to get tenants out of properties now. Daniel said, I've made it protected for tenants. He's actually made it a hell of a lot easier for us and for you. And I can see a couple of you who've had recent circumstances that would have played very nicely into our hands. So we look forward to having that one. There's a whole bunch of other notices for bits and pieces, but I won't bore you with those. I'm very happy from my staff's perspective. I've got 22 staff that work for me in our team, and 20 of them are young women. Most of you would have met my team. And unfortunately, every now and then there are tenants who think that it's okay to be abusive and rude and intimidating to my staff, sometimes on the verge of violent. And now we have a notice to vacate that we can use if they are abusive, or it's technically called threatening or intimidating to you, a supplier of yours or your agent. You can now give them a notice to vacate. So I'm personally, as the manager of those people, I'm very, very happy about that. Non-payment of rent. Now, just in case you didn't know, Daniel Andrews can't count. I'll explain why. He's brought in a new rule. It's called the 3 strikes rule, right? How do we count to 3? 1, 2, 3. Yeah, so it's on the 5th time the tenant gets 14 days in arrears, you can serve the notice. This is 1, 2, 3. Anyway, very confusing. So basically what happens is still got the 14-day notice to vacate for rent arrears. If the tenant pays the rent before the notice expires, you can't make an application to VCAT. Previously, what we would do is we go for you anyway, and we would get a adjournment of the hearing, and then we'd be able to go back instantly and get the tenant out the second time. Can't do that anymore. Now it's the 3 strikes/5 strikes rule. So you've got to do 5 notice to vacates for 14 days, and then you're able to make an application to VCAT even if the tenant's paid. Now, if the tenant is 14 days in arrears, they still don't pay, you can still make your application like normal, but as soon as they pay, the application's withdrawn. So that's going to be on. It has to be within a 12-month period too. So if you tick over 12 months, the clock starts again on the 5/3 strikes rule. So that one's fun. There's a couple of other bits and pieces there, but we'll talk you through it at the time. Excellent news as well is that VCAT's now not. Previously, they were allowed to make a judgment as to whether or not they thought a tenant would do a behaviour again. So say, for instance, a tenant was a danger to a neighbour or they caused damage to the property, VCAT were allowed to make an assessment of whether they thought the tenant would do that behaviour a second time. And if they didn't think the tenant was likely to make that behaviour again, they wouldn't give you an order of possession. We're very happy now that the crystal ball that they seem to have had, that nobody can find, it's at VCAT by the way, of whether a tenant's going to repeat a behaviour is now gone. They'll probably give it to Tim from EBM so he knows what's going to happen with insurance claims maybe. But it means that no longer are they able to make that judgment. If the tenant has had a behaviour before, the assumption is they'll do it again, which in basic psychology tell us is the right answer. Break leases are now in the Act, so it's very easy for us to get fees back if tenants do break their lease, which is good for you because it just keeps those costs down. There's also, just back on that, there's also a whole bunch of new provisions around family violence as well. So essentially, the easiest way to explain it is that if you have a tenant in a property and a family violence event occurs, they essentially can walk away from the tenancy because it's unsafe for them to remain in a property where the perpetrator knows that they live. And I think any landlord would agree that that is perfectly reasonable. I haven't seen anybody argue on that point. It's now just very clear. There was they'd put a bunch of sections in a few years ago. Now it's just very clear process of how you go about that. So from here, we'll get regs soon. As soon as the regulations, which is the second part of the legislations, are out, we'll start to funnel some information through to you. If you do want to attend any more training, some landlords like to be right up to date. I know a couple of our clients who manage some of their own property are here. Consumer Affairs Victoria will be running a huge program across the state at regional centres as well. They're due to release the dates for that shortly, and the Real Estate Institute of Victoria is looking after training on an agency behalf. Jellis Craig is consulting on both of those, so we'll actually be leading the way of training across the whole state. So your property managers will be the best trained that there are in all of Victoria. So we're very happy to tell you that we'll be the experts on that and be able to tell you what's happening. Well, thank you so much for coming. We really appreciate you being here, and we look forward to having another night.